Everyone knows that the US-China trade war has sent tariffs skyrocketing, and manufacturing should be returning to America. That sounds perfectly logical, according to basic economics. When Chinese goods become expensive, American consumers should naturally turn to domestic products, and factories should start sprouting up across American soil again. But reality has turned out completely different. Even when facing punitive tariffs of up to 145%, American manufacturing hasn't seen any massive comeback. While Chinese factory owners would rather absorb huge losses than abandon the US market. What's the secret behind this paradox? Why have textbook economic theories failed so spectacularly in the real world? Today, we're diving deep into 3 overlooked critical issues. Who are the real victims of this trade war? How staggering are the hidden costs of global supply chain restructuring? And why is the $600 billion trade relationship far more complex than anyone imagined? In April 2024, what seemed like a routine policy announcement completely changed the fate of millions of people. U.S. tariffs on Chinese goods jumped overnight from 7.4% to a crushing 145%, while China's retaliatory tariffs hit 125%. This wasn't gradual adjustment. This was economic warfare, plain and simple. In Guangdong's manufacturing heartland, factory bosses experienced what you might call a policy earthquake for the first time. Companies that had been running smoothly for decades suddenly found their products priced out of the American market. A kitchen spatula that used to sell for $5 would now cost $12 with tariffs included. And American consumers obviously weren't going to pay that premium. But the deadliest blow wasn't the tariffs themselves. It was the order panic that followed. American importers went into overdrive, frantically stockpiling goods before the new tariffs kicked in. Then suddenly slammed on the brakes, freezing all orders while waiting for policy clarity. This wild demand swing caught Chinese manufacturers completely off guard. The numbers tell the story. What had been steady, predictable order flows turned into a roller coaster that no business could plan for. Companies that had built their operations around consistent American demand suddenly found themselves staring at empty order books, not knowing if this was temporary turbulence or the new normal. When tariff policy changes started happening, faster than business cycles could adapt, a deeper crisis began to emerge. This wasn't just about rising costs anymore. The entire time logic of the business ecosystem had been turned upside down. Data from Guangdong's manufacturing hub reveals just how brutal this disruption was. Medium-sized manufacturers like Valong Enterprises saw annual revenues plummet from a steady $150 to $160 million, straight down to $120 million. A devastating 20% drop. But the real story lies beneath these numbers. The revenue decline wasn't spread evenly. It came in wildly irregular waves that no business could predict or prepare for. The root problem was a massive disconnect between American retail's built-in purchasing cycles and the chaotic rhythm of policy changes. U.S. retailers have to lock in their buying decisions during specific time windows each year. Spring merchandise orders must be finalized by October of the previous year, summer goods by December, fall items by February. This rigid timeframe had been the foundation of global trade for decades. But the constant policy flip-flopping shattered it completely. When the tariff relief policy was announced in May, American buyers faced an impossible timing dilemma. The next purchasing season was still 4 months away, but the policy would only last 90 days. They couldn't restock for the season they'd already missed, and they didn't dare place bets on future purchasing cycles. This timing mismatch created a commercial vacuum that left manufacturers' order books eerily blank. The psychological impact was even more devastating. American distributors who had worked with Chinese manufacturers for over a decade started questioning the value of long-term partnerships for the first time. Their inventory management shifted from lean inventory to safety inventory, preferring to risk stockouts rather than take losses from policy changes. This mindset shift spread through the entire supply chain network at lightning speed. Analysts discovered this caution was creating a whole new business model, order fragmentation, where a distributor might have placed one order for 100,000 units before. Now they were splitting it into 10 orders of 10,000 units each. On paper, the total volume looked the same, but for manufacturers, production costs skyrocketed. Economies of scale vanished, fixed cost allocation increased, and profit margins got squeezed even tighter. The supply chain finance system started showing cracks too. Banks found that previously reliable accounts receivable had become unpredictable and began tightening. Credit to manufacturing companies. A vicious cycle took hold. Policy uncertainty led to order volatility. Order volatility led to unstable cash flow. Unstable cash flow further limited companies' ability to weather policy shocks. Among all the policy changes, most overlooked, but devastatingly effective, was the elimination of the de minimis rule. This Latin term, meaning too small to matter, had allowed packages worth under $800 to enter the U.S. duty-free to outsiders. This looked like a minor technical adjustment, but for small and medium enterprises, it was life or death. This seemingly insignificant rule change actually slammed shut a crucial gateway for SMEs to enter the American market. The data tells the story. In 2023, over 1 billion packages entered the U.S. through the de minimis channel, worth roughly $200 billion total. A significant portion of these small packages came from Chinese SMEs and e-commerce sellers. The impact was immediate and brutal. Take a $30 item as an example. For sellers only had to cover shipping and platform fees. They had to tack on tariffs, customs processing fees, warehousing costs, and other charges. These additional fees typically ran $15 to $25, pushing the final selling price above $50 and completely killing market competitiveness. The deeper impact was a fundamental change in business models. The small package model allowed companies to run small batch tests using e-commerce platforms to quickly validate market acceptance before committing to large-scale investment. This low-risk market entry approach was perfect for innovative SMEs, letting them explore overseas markets without massive upfront capital. After the rule change, small businesses either had to absorb crushing per-unit costs or switch to large volume export models. But large volume exports require complete trade credentials, substantial working capital, and professional logistics networks. These barriers locked out the vast majority of small enterprises. Incense producers in Yunnan handicraft, manufacturers in Guangzhou's small appliance companies in Zhejiang. Tens of thousands of small manufacturers lost their direct connection to American consumers. This change also accelerated the split in e-commerce platform ecosystems. Large sellers could absorb the new costs through economies of scale, while small sellers saw their profit margins completely wiped out. The number of Chinese small sellers on platforms like Amazon and eBay began dropping significantly, replaced by a few large trading companies running centralized operations. From a macro perspective, eliminating the de minimis rule is actually reshaping the landscape of global small goods trade. It's not just affecting U.S.-China trade, but the entire structure of global e-commerce supply chains. Small manufacturers who used to serve global consumers through direct shipping models now have to find new business approaches, and the costs and risks of this transformation are enormous. When the U.S. market became unpredictable, the China+1 strategy became the lifeline manufacturers kept talking about. This seemingly simple concept, building another production base outside China to dodge tariff risks, quickly became the new gospel of global manufacturing. But the reality behind the data is far more complex and brutal than it appears on the surface. In the first half of 2024, manufacturing investment in Southeast Asian countries like Vietnam, Cambodia, and India exploded. Vietnam alone saw Chinese direct investments surge 67%, hitting historic highs. On the surface, this seemed to prove successful industrial transfer. But deeper analysis reveals a picture full of contradictions. First came the fundamental deterioration of cost structures. One electronics manufacturer's case is typical. Their new Vietnamese factory was only one-third the size of their Chinese facility. but total investment reached 60% of what the Chinese factory cost. This cost inversion stems from Southeast Asia's severe lack of industrial supporting infrastructure. In China, a phone assembly plant can find all necessary component suppliers within a 10-kilometer radius. But in Vietnam, the same components might need to be imported from China, dramatically increasing both transportation costs and time. The human resources bottleneck is even more serious. While Southeast Asian countries have relatively low basic labor costs, skilled technical workers are extremely scarce. Training a skilled production line operator might take just 2 to 3 weeks in China, but often requires 2 to 3 months in Cambodia or India. With employee turnover rates hitting 30 to 40%, this gap not only drives up training costs, but seriously impacts production efficiency and product quality. Infrastructure backwardness is another problem that can't be solved short-term. Unstable power supply, incomplete logistics networks, and backward communication facilities. These seemingly basic issues have become serious constraints on manufacturing development. Many companies discovered they needed to build their own power generation, equipment, logistics warehouses, and even communication networks. These extra investments far exceeded expectations. The most ironic issue is supply chain dependency. Even with factories in Southeast Asia, these companies still heavily depend on Chinese raw materials and intermediate product supplies. Statistics show that among made in Cambodia, goods produced in Cambodia, an average of 70% of the value still comes from China. This means this industrial transfer looks more like industrial extension. It hasn't really broken free from dependence on Chinese supply chains, when large numbers of Chinese companies simultaneously rushed into these relatively small economies. Competition quickly became cutthroat. The original cost advantages disappeared fast as land prices rose, labor costs climbed, and infrastructure became even more strained. Some early entrants found their first-mover advantages being eroded by price wars from latecomers, uncertainty in the U.S. market. Chinese manufacturers began massively exploring alternative markets, with Europe seen as the most promising option. After all, the EU is the world's second-largest consumer market and relatively stable in trade policy. But reality quickly proved how naive these expectations were. European and American markets have fundamental differences. American consumers are relatively open to new products and brands, willing to try goods from different countries, while European consumers tend to stick with familiar brands and proven products. This cultural difference means Chinese manufacturers need to invest heavily in brand building and market education, exactly the capability they lack most. Market saturation is an even grimmer challenge. The European market, developed over centuries, has formed relatively mature and stable supplier networks. From German industrial products to Italian fashion goods, from French luxury items to Nordic design products, every niche has strong domestic brands and dominant positions. Chinese manufacturers trying to gain share often can only do so through price wars, but this triggers EU anti-dumping investigations. Data shows that in the first half of 2024, while some Chinese companies shifted 30% of their capacity to Europe, overall profit margins dropped 15 to 20%. The reason is simple. Fierce competition forced companies to slash prices, while Europe's strict product standards and environmental requirements drove up compliance costs. Many companies found themselves in an impossible bind. No price cuts meant no orders, but price cuts meant no profits. Regulatory complexity is another underestimated challenge. The EU's REACH regulations, RoHS directives, CE certification, and other technical trade barriers left Chinese companies accustomed to relatively relaxed regulatory environments. Scrambling product certification fees alone could account for 5 to 10% of goods. Value a massive burden for low-margin manufacturing. Developing country markets looked like another option, but purchasing power constraints became a fundamental barrier. A kitchen tool that could sell for $5 in America might only fetch $2 in African or Latin American markets. With additional currency and political risks, while these markets' overall scale is growing, They can't absorb the massive capacity shifting from America in the short term. When all alternative market efforts hit roadblocks, harsh reality became undeniable. American consumers' purchasing power and consumption habits are unique globally. This isn't just reflected in market size, but in fundamental differences in consumption structure and psychology. The numbers tell the story best. In 2024, even during the most intense period of trade war, U.S.-China trade volume still reached $600 billion. America imported $439 billion from China, while exporting $143 billion to China. This scale not only far exceeds any other bilateral trade relationship, but more importantly reflects the deep complementarity of both economies. American consumers' purchasing power advantage is overwhelming. Typical American middle-class families. Annual income runs $50,000 to $80,000, exceeding the per capita GDP of many developing countries. Even when product prices rise 30 to 50% due to tariffs, American consumers can still afford them. The same price increases in other markets might mean complete loss of competitiveness. The consumption culture difference is even more crucial. American consumers are more willing to pay for convenience, innovation, and personalization, providing huge value and opportunities for Chinese manufacturers. A simple kitchen gadget that solves specific American household needs can command premiums, far exceeding costs. In other markets, consumers focus more on basic functionality and price, leaving extremely limited profit margins. American market openness is also unmatched by other markets. In America, a completely new brand can quickly reach national consumers through retail giants like Amazon and Walmart, while building distribution channels in Europe or other developed markets often takes years and massive investment. This market access convenience has allowed countless Chinese SMEs to succeed in the American market. The sophistication of the financial system is another important factor. America has the world's most developed consumer credit system, allowing consumers easy access to credit cards and installment payment services, greatly boosting consumer spending. In many other markets, consumers rely mainly on cash transactions, limiting sales of big-ticket items. From a long-term perspective, America remains the global leader in innovation and consumption trends. Products that succeed in the American market are often copied and adopted by other markets, providing extra brand value for companies with U.S. operations through this demonstration effect. Losing the American market doesn't just mean losing direct revenue, it means losing the opportunity to participate in global innovation networks. Facing such severe external shocks, China's economy showed surprising resilience. Second quarter 2024 GDP growth hit 5.2%, far exceeding outside expectations, achieved even as exports to the U.S. dropped 24%. On the surface, this seemed to prove China's economy had strong internal momentum and risk resistance. But deeper analysis reveals some worrying structural problems. First is the issue of growth quality. 5.2% growth relied heavily on infrastructure investment and real estate. Market support and the sustainability of both sectors faces questions. When external demand shrank, the government boosted investment to offset economic downward pressure. This approach works short-term. Long-term, it might worsen overcapacity and debt risks. Changes in export structure also deserve attention. While overall, exports achieved 6% growth. This growth mainly came from increased exports to other developing countries. And these markets generally have lower profitability than the U.S. market. Many companies had to accept lower profit margins or even sell at losses to maintain export volumes. This strategy of using quantity to compensate for price looks good in statistics. But it's harmful for companies' long-term healthy development. Deflationary pressure is becoming a serious problem. The PPI Producer Price Index declined for multiple consecutive months, meaning companies' pricing power is weakening. When companies are forced to cut prices, it doesn't just directly affect profits, it also impacts investment willingness and innovation drive. Once deflation takes hold, it creates a downward spiral. Falling prices gives reduced profits, gives decreased investment, gives falling demand, gives further price drops. Employment market pressure is also building, while official unemployment data remains relatively stable. Manufacturing job quality is declining. Many factories have been forced to reduce working hours, cut wages, and eliminate bonuses. These changes won't immediately show up in unemployment statistics, but they affect workers' income and consumption capacity. Rising youth unemployment is particularly concerning, as it could constrain long-term consumption growth, deteriorating. Corporate financial conditions are another hidden risk. Many manufacturing companies have started using reserve funds or even taking on debt to maintain operations. While banks' overall non-performing loan rates remain controllable, manufacturing-related loan risks are rising. If external conditions worsen further, it could trigger a chain of debt defaults. The deeper problem is the impact on innovation capacity. When companies focus their main energy on dealing with trade shocks, R&D investment is often the first item. Cut short-term, this approach can improve cash flow, but long-term, it weakens corporate competitiveness. For China's economy to achieve high-quality development, it must rely on innovation-driven growth. The trade war is undermining this innovation capacity. The China+1 strategy sounds simple, but implementing it involves complexity and costs far beyond imagination. Every company attempting supply chain diversification is bearing enormous duplicate investment pressure, and these costs will ultimately show up in product prices paid by global consumers. Duplicate construction is the most obvious cost. A production line that runs maturely in China needs to be rebuilt in Southeast Asia, requiring not just purchasing the same equipment, but retraining workers, re-establishing supplier relationships, and perfecting quality control systems. For the simplest manufacturing, this duplicate investment often reaches 60 to 80% of original investment. For complex manufacturing, this ratio might exceed 100%. Increased management complexity brings hidden costs. When production spreads across multiple countries, maintaining unified quality standards becomes extremely difficult. Different countries, workers' skill levels, work habits, and cultural backgrounds all vary, requiring companies to invest massive resources in standardized management. Many companies discovered that managing multiple overseas factories costs far more than expected. Supply chain efficiency losses are also enormous. China's manufacturing cluster effects, built over decades, were artificially scattered, and procurement that could be completed in one day now might take a week. Rising logistics costs, increased inventory pressure, and slower response times. These efficiency losses translate into real economic costs. Currency risk is another underestimated factor. When companies operate in multiple countries, they must deal with multiple currencies, exchange rate fluctuations. Hedging these risks requires professional financial tools and teams, increasing operational costs. Moreover, exchange rate fluctuations often correlate with trade policy changes, making risk management even more complex. Technology transfer costs can't be ignored either. Many manufacturing processes require experienced technical personnel, and these people often aren't willing to work overseas. Long-term, companies have to send technical backbone staff to overseas factories or spend huge amounts training local employees. This technology transfer is not only costly, but also faces risks of technology leakage. Most serious is the increase in systemic risk. Decentralized supply chains seem to reduce single-point risks, but actually increase system complexity and fragility. When one link has problems, coordination costs for the entire supply chain skyrocket. During the COVID-19 pandemic, many decentralized supply chains actually proved more fragile than centralized ones. From a macro perspective, this supply chain restructuring is actually reducing global economic overall efficiency. Cost optimization achieved through comparative advantage and economies of scale was artificially broken. Global trade costs rose, and ultimately, consumers have to pay higher prices for the same goods. This is a typical negative-sum game where all participants lose. One core goal of the trade war was to drive manufacturing back to America and rebuild America's manufacturing base. However, over 2 years of practice has proven this goal is basically unrealistic. Obstacles to manufacturing reshoring aren't just cost issues, they involve the absence of entire industrial ecosystems. Labor cost gaps are the most obvious barrier. Average hourly wages for U.S. manufacturing workers run about $28, while Chinese manufacturing workers earn $4 to $6 per hour. Even accounting for productivity differences, this gap remains enormous. More importantly, young Americans lack interest in manufacturing jobs, preferring service or high-tech industries. Skilled worker shortages are an even more serious problem. American manufacturing has shrunk dramatically over recent decades, and related skills training systems have deteriorated accordingly. Rebuilding manufacturing now requires not just new factories and equipment, but retraining an entire generation of skilled workers. This process needs 5 to 10 years and massive investment. Missing industrial ecosystems are the most fundamental obstacle. China's manufacturing advantages aren't just low-cost labor, but complete industrial chain support. A phone manufacturer in Shenzhen can find all necessary component suppliers, mold manufacturers, packaging material vendors, and logistics service providers. This industrial cluster effect can't be replicated quickly. Environmental and safety standards also drive up U.S. manufacturing costs. While these standards are necessary for protecting the environment and worker health, they do increase production costs. Many processes and materials usable in developing countries are prohibited in America, requiring companies to invest in more expensive alternative technologies. Different automation levels are another important factor. Building factories in America often requires higher automation to offset labor cost disadvantages. But this means massive upfront investment and longer payback periods. Moreover, highly automated factories create limited jobs. Contradicting trade policy's original intent, market scale is also a realistic constraint. Many manufactured products have limited global market size that can't support large-scale production bases in multiple regions. Companies must weigh costs against market coverage, and Chinese manufacturing bases often remain the optimal choice in this trade-off. Finally, even if some manufacturing really does return to America, it doesn't mean corresponding job increases. Modern manufacturing increasingly relies on automation and intelligence. A modern factory might need only dozens of workers to achieve output that previously required hundreds. What might return is manufacturing capacity, not manufacturing employment. In this trade war, the most easily overlooked but most deserving of attention are small and medium enterprises' predicaments. They have neither large companies' financial strength and risk resistance, nor multinational corporations' globalization experience, yet they must bear the same or even more severe policy shocks. Cash flow pressure is the most direct threat facing SMEs. Large companies can handle short-term revenue declines through diversified businesses, ample cash reserves, and convenient financing channels, but SMEs often have only single product lines and limited financial reserves. When order volumes drop 20 to 30%, many SMEs immediately face cash flow rupture risks. Tightening bank credit policies further aggravate this predicament. When the entire export industry's risks rise, banks naturally tighten lending standards, and SMEs are often the first victims. They lack sufficient collateral, lack perfect financial management systems, and lack bank-recognized risk control capabilities. Insufficient transformation capacity is another key issue. When the U.S. market became unpredictable, large companies could quickly adjust strategies, exploring new markets or turning to new products. But SMEs often focus on specific niche markets, lacking resources and capabilities for rapid transformation. Their specialization advantages are competitive strengths in stable environments, but become disadvantages in rapidly changing environments. Brain drain is also accelerating. Company prospects are unclear. Excellent employees often choose more stable large companies or other industries. SMEs already struggle to attract and retain talent, and the trade war has further aggravated this difficulty. Some key technical personnel leaving can directly impact companies' production capacity and product quality. Declining innovation capacity is a long-term hidden danger. SMEs are often important sources of innovation. They're flexible, make quick decisions, and dare to try new products and services. But when survival becomes problematic, innovation investment is often the first item cut. This not only affects these companies' long-term competitiveness, but also impacts the entire economy's innovation vitality. Supply chain marginalization is also happening. When large companies restructure supply chains, they often prioritize suppliers that are large-scale, capable, and low-risk. SMEs might find themselves gradually excluded from new supply chain networks, losing opportunities to participate in global trade. More serious is opportunity cost loss. Many SMEs originally had good development prospects, but the trade war forced them to focus mainly on dealing with short-term crises, missing market opportunities they could have seized. This opportunity cost could be fatal for companies' long-term development. The trade war's impact goes far beyond bilateral trade relations. It's driving deep restructuring of global trade rules and systems. This restructuring is not only changing the pattern of commodity flows, but more importantly, changing the basic logic of global economic cooperation. The multilateral trading system is experiencing unprecedented shocks. WTO dispute resolution mechanism paralysis, countries' unilateral trade policies proliferating, regional trade agreement fragmentation, all are weakening the global trade governance system built over recent decades. Replacing it is a more divided, more uncertain trade environment. The rise of economic security concepts is redefining trade policy objectives. Traditional trade theory emphasized efficiency and mutual benefit, but now countries increasingly consider non-economic factors like supply chain security, technology security, and data security. This shift makes trade policy more complex and unpredictable. Technology competition is becoming the core of trade conflicts. From chips to artificial intelligence, from new energy to biotechnology, competition in technology fields involves not just economic interests, but national competitiveness and security. This competition is characterized by stronger zero-sum nature, smaller cooperation space, and more government intervention. Supply chain friendshoring and nearshoring trends are reshaping global production networks. When choosing suppliers and investment locations, companies no longer consider just costs and efficiency, but also political risks and supply chain security. This change reduces global supply chain efficiency, but increases resilience and controllability. Missing digital trade rules also bring new challenges. With rapid digital economy development, cross-border data flows, digital service trade, and e-commerce urgently need corresponding international rules. But countries have huge differences on data governance, privacy, protection, digital taxation, making it difficult to form unified rule systems. Developing countries face special challenges in this restructuring. They often depend more on global trade, but have limited voice in formulating new rules. When major powers have trade conflicts, small countries are often forced to choose sides, further aggravating global trade system fragmentation. Long-term, this restructuring might lead to balkanization of the global trade system. Trade blocs operating under different rules, with increased trade barriers between them. This trend is unfavorable for global economic growth, technological progress, and poverty reduction goals. When we review this entire process, a thought-provoking reality emerges. In this confrontation called a trade war, there are no real winners. 145% tariffs haven't brought large-scale return of American manufacturing. Instead, they've created a global trade environment that's less efficient. It's more expensive and riskier. Chinese manufacturers are bearing the pressure of reduced orders and razor-thin profits. American consumers face rising prices and fewer choices. Global SMEs struggle to survive in the cracks, while the massive costs of supply chain restructuring ultimately must be borne by consumers worldwide. More ironically, even under such severe trade sanctions, the US and China still maintain $600 billion in trade volume, proving the degree of economic interdependence between the two countries is far deeper than politicians imagined. Perhaps the most worthwhile question for reflection isn't who will win this trade war, but what price human society will pay for this transformation when globalization logic gets replaced by politicized considerations. When efficiency principles give way to security principles. In an increasingly divided world, the real challenge isn't how to win in competition, but how to find possibilities for cooperation amid differences, and maintain humanity's common interests amid fragmentation.